So what is Goodwill? Goodwill is an asset that's created during the acquisition of a company and reflects the difference of the purchase price of the fair value of the assets being acquired. Now, what the heck does that mean? Well, let's just say you and I start bakeries. I focus on brownies and you focus on cookies. Both of our businesses grow, and while I'm looking to expand, you're actually looking to retire to a private island near Fiji. Congratulations. We agree to a deal and I end up paying $100 million for your cookie business. Now, how did we agree on $100 million? Number of factors we took into account. We looked at your locations, all of your equipment, your operations, your performance over the last few years, your leadership, your position in the marketplace, your name recognition, et cetera, et cetera. We estimated how all of those things would drive cash flows and growth for the combined bakery into the future and calculated what all of that future value is worth to me today. When we started accounting for the acquisition, we found that all of your real estate, equipment, tangible assets, intellectual property, and other assets we could identify are only worth $75 million. Now that poses a $25 million difference, and it's a big problem for the balance sheet, which always has to balance. That $25 million is what we call goodwill. It represents the value I placed on the prospect of future cash flows and growth that can't be attributed to the other assets I acquired from you. It can also reflect whether I've overpaid for your bakery. So why does goodwill really matter? I once heard an NYU business professor, known as a business valuation guru, say something to the effect that goodwill is the accounting profession admitting they're wrong. In other words, it's largely an accounting issue, and goodwill doesn't generally impact the way that we manage the day-to-day business. But it does pose a big challenge if my assumptions weren't correct. Now let's just say the cookie market dies and nobody is buying cookies anymore. I have a whole division based on cookie sales. And unfortunately, that means that business I bought from you isn't worth the $100 million I paid. In that case, accounting rules say that I have to adjust the value of that business and the goodwill on my balance sheet. I have to reduce the goodwill. Now, when I have to reduce the goodwill, I have to take what we call an impairment expense, and it may wipe out the entire $25 million I had recorded earlier. And as an expense, it actually flows through my income statement, and that year it would negatively impact my earnings. Now, there are other nuances about goodwill and how we can treat goodwill, and they may have significant impact on how our performance looks, but it all depends on whether we're in US or outside of the US and how those accounting rules apply. We're not going to cover those here. What do you really need to remember about goodwill? Goodwill reflects the value we place on the prospects of future growth and cash flows, and maybe a little overpayment when we buy another company. And it's the difference between the purchase price and the market value of the assets we purchased. So what does that mean for you? Well, understanding goodwill is essential when evaluating mergers and acquisitions. If you're in finance or strategy, recognizing the implications of goodwill can help you make informed decisions about the true value and potential risks of an acquisition. For those of you in management, it highlights the importance of maintaining and growing the acquired business to justify the premium we've paid. By appreciating the nuances of goodwill, you can better manage your company's assets, make strategic investment decisions, and ensure the long-term success and stability of your organization.